Good afternoon, ladies and gentlemen. I am Barry Eichengreen from the University of California at Berkeley. It's my pleasure to moderate this panel. This is the panel on the subject that everybody has been waiting for, redesigning financial regulation, with a focus in particular on how the largest financial institutions in the world should be regulated domestically and internationally. We do have an extraordinary panel this afternoon. Agustin Carstens, the governor of the Central Bank of Mexico, Stanley Fischer, the governor of the Bank of Israel, Pravin Gordhan, Minister of Finance of South Africa, Davide, Serra, who is founder and managing partner of Algebris Investments, Tidjane Thiam, who is Group Chief Executive of Prudential in the UK, and Jean-Claude Trichet, who is President of the European Central Bank. So that clearly is a diverse panel. We have the public sector represented, we have the private sector represented, we have representatives of all the relevant points of view, except perhaps that of the US administration. But then why should this panel be different than any of the others here at Davos this year? So the gods of Davos have given us a batting order. Mr. Trichet will lead off with a 3-minute opening statement, and he will be followed by Misters Fischer, Thiam, Gordhan, Carstens, and Serra in that order. Jean-Claude, please.
Yeah, we see that Davos is very generous. 3 minutes on such a very important subject. Let me first say that we are bound to improve considerably regulation. We are bound, it's only part of the exercise, to make the financial system much more resilient than it was before, because we cannot afford to have a financial system which would be as fragile as it was before. Second, I would say that this very, very important issue, as all others, has to be treated at the level of the international bodies that we have created, because the level playing field, the fact that we must have global rules to treat issues that are of a global nature, is absolutely essential. And on that matter, there are work in progress of the G20, of the Financial Stability Board, and of the Basel Committee. And we are all working very, very actively on that matter. We already published a number of papers on that. And I would conclude in this 3 minutes first presentation in saying that what we have to do is, by all means, to first minimize the risk of a failure of a systematically important institution, which means not only large, as has been presented, I would say, but the size counts, the interconnectedness counts, the fact that you occupy a function which is not easily substitutable is also something which is very important. We have to judge that, of course, to make a judgment on what is really systematically important. Limit first the probability of having a big problem, which calls for appropriate measures that would be directed to this individual institution. We have then, if failure appears to be unavoidable, despite the measures that would be taken and directed to the institution, we need, of course, to have the kind of living wills of resolution environment, legal environment that is needed. And then we have an enormous work to do, particularly as regards the cross-border institution. Resolution is absolutely key. And then, of course, we have to strengthen the system itself, particularly, I have to say, the infrastructure, in order to minimize the fallout of collapse, a possible collapse. All this means, in my opinion, a very, very large multidimensional exercise, and certainly not a single measure which would fix the problem. It is very complex, multidimensional, and we have to work a lot.
Thank you very much. Much too complex and multidimensional for any of us to do justice to in 3 minutes. Stan?
I'd like to relate to 3 issues in 3 minutes. One is issues related to the size of the institutions. Second is international aspects of the problem. And the third is the range of institutions that we're talking about. On the issues of size, we have the undoubted conclusion that the bigger they are, the more difficult they are to deal with. And this has led to one approach, which I think is very clear, which is that the larger the banks, the larger the liquidity ratios they should be required to have, and the larger the capital ratios. Alternatively, one can imagine firm limits on their size. It's always better to have a price than a quantity limit, so I tend to favor the differential capital and liquidity ratios. Related to size is the issue of too big to fail. That issue is not the right issue. The issue there is whether the institutions are too big to resolve. That is to say, whether they can be run down after they become insolvent in a way that minimizes the damage to the financial system. And so we're looking for resolution mechanisms that are realistic for even the biggest of firms, and I believe they can be discovered and put in place. Secondly, on international aspects, there is a clear desire for international uniformity of regulation across borders. It cannot be identical. Each market is different, but certainly uniformity of approach. And one important development since the crisis has been the setting up of the Financial Stability Board to replace the Financial Stability Forum. It has done a great deal of excellent analytic work, produced many recommendations that are very important. Now we wait to see those being put into practice. And there is a delicate balance between getting coordination and getting measures put in place. And at some point, countries may just elect to move ahead rather than wait for continued negotiations over uniformity. Let me mention one other issue in relation to size. That's the fact that in crises, international firms tend to become national firms. That is, they withdraw money from their countries other than the headquarters country and thereby spread the contagion. And there is considerable discussion of whether it wouldn't be preferable to have subsidiaries in individual countries rather than branches, so that they would be subject to local supervision as well. Third issue, the range of institutions we're talking about. The question was how to regulate the largest financial institutions. And we come then to things like insurance companies. I believe that the approach that's contained in the draft law that was presented by the Obama administration, in which institutions that would have access to the lender of last resort should be supervised by the lender of last resort. This would mean that even insurance companies which have access to the lender of last resort would be supervised by the central bank. That seems to me an entirely coherent approach to the range of supervision of the largest institutions, namely that most of them should be, all of them should be supervised by the central bank. Thank you.
Thank you. Mr. Thiam, please.
Thank you. I'm often accused of speaking too fast, so giving me 3 minutes is really a provocation, but I'll try to stay understandable. The first thing I'd like to say is that we acknowledge absolutely the need to change. When I say we, I think large companies, international financial institutions. There's been a lot of debate on the crisis, its causes. I won't go into that, but I think there is a recognition, and hopefully that came across here at Davos, that we need to change in response to the environment. Second thing I'd like to say is around the type of regulation we want and that we would welcome. We insist on the importance of the quality of a dialogue between regulators and regulated. We insist on relevant experience and expertise from the regulators. I'd just like to go back to one episode here. My company has been in activity for 160 years. In Q4 of 2008, I was the CFO, and out of the 10 worst trading days of the company in 160 years, 6 happened in October and November 2008. So that's a very special feeling and a period that I'm not close to forget. But when Bradford and Bingley in the UK went bankrupt, there was a period where it was a discussion about cancelling the preferred shares. So we, the insurance companies, had to react very quickly and explain that 15% of the assets backing the liabilities of pensions in the UK were of that nature. And by making that decision that afternoon, someone was at risk of bankrupting the whole pension system in the UK. So at times like that, the dialogue, the openness, the access is absolutely vital, because it's often the difference between a good decision and a catastrophic decision. So it's easy to say dialogue, but it's important to understand that it has a real impact on the survival of companies. The other thing we'd insist on is really differentiation. No one size fits all. Countries are very different, companies are very different, sectors are very different. These are complex realities, and we're always a bit nervous when we hear people talking about uniform approaches and so on. I think it's a real concern for us. We also want regulation to be predictable. The issue of fungibility that Stan Fisher just alluded to is very important to us. So again, good dialogue, relevant experience, differentiated regulation are important for us. As far as who does it, frankly, we're not very, we don't, I think, have very strong views. What we want is for the regulation to work and to be effective. It will vary from one country to another, which brings me to the last set of issues I'd like to address, which is the international coordination. And there, my company is active in the UK, in the US, and in 13 Asian countries. What we want is consistency. We think that regulation has to be consistent and is not likely to ever be identical. What we want is consistency in the approaches and the principles, so that as a company, we're not in a situation where we're exposed to regulatory arbitrage, which is very damaging for us. And the final thing around failures and moral hazard is that we believe that it's important that companies are allowed to fail, but part of a market economy, it's very important, and we're just nervous when I've seen one paper written by one important regulator saying that the new approach would be to make sure that no large company would ever go bankrupt. Well, we think that's wrong. We think that good companies should be able to push out bad companies, and that bad companies or poorly managed companies should die. So I subscribe completely to what Stan Fisher said about the orderly resolution after a failure, but I don't think that the system should ever take as an objective to absolutely avoid failure. Thank you.
Thank you, Minister Gordhan.
Thank you. I think my colleagues have covered the technical aspects fairly well, so let me introduce 3 or 4 other perspectives and issues into this debate. We've had, I think, over the last 14 or 15 months, world leaders of the G20 meeting on 3 different occasions to look at the crisis, to look at what will resolve the crisis, and to finally in September in Pittsburgh, look at what progress we're making in that regard. Now, the question for me is whether the constituency, that is the large banks that is at the center of this issue and problem, have sufficiently reflected upon their business models, their mindsets, and the paradigms that they work with in order that they could not just be required to fall within regulations that the FSB and others provide, but also proactively lead their businesses into new business models and to think differently about the way they do things. So the question I'm asking here is, are we really moving into a new era? If we are we all sufficiently prepared and preparing ourselves to do so? Are we all just hoping that after this crisis, and perhaps with a few more technical requirements and reporting requirements, we can go back to the old normal? The second point is regulation for what? And it links to my first point. If the regulation that we are talking about is to repair the past and to marginally improve that past, then I don't think we're doing ourselves and the billions of people upon which the financial system has had a negative impact much good. So a question that I think all of us face, both as finance ministers and as technical people involved in this process, is how do we go beyond the immediate? How do we recast the relationship between the financial system and the real economy? And when we talk about regulation, how do we not just ensure that we're not too big to fail and that we have living wills and so on, but also buffer the real economy and the lives of real people from the impact of failures in the financial economy? The third point is how. And clearly here we need to take into account differentiation. Many of these operations are global, so clearly global institutions are required. We're moving, I think, into a period over the next 6 to 9 months where regulations will be very clear. And the next question that will arise is who enforces those regulations? And what will be the consequences if there's non-compliance with the regulations? And are there sufficient sanctions and mechanisms available in order to ensure that we move in the right direction? So that's again, something for us to think about. The last point, perhaps, that I need to make is that all banks are not the same, although in this instance we're talking about the largest banks. And in formulating the new regulations, we need to take into account that in many developing countries, there in fact was no financial system crisis. Those banks worked fairly well, the regulators worked fairly well, although ordinary people face the impact of the failure of the financial system. So is there a need for differentiation between the very large banks and other banks, and what would that mean in terms of differentiated regulations? Thank you.
Thank you, Pravin. So for me, that comment about implementation and the comment about whether there really will be a new regulatory regime as opposed to a new rhetoric going forward really is the point of the panel, and we have 40 minutes to answer it. Agustin Carstens is next.
Thank you, Barry. We have a regulation that pretty much relies on capital requirements, and capital requirements, of course, related to risk-taking. What this crisis has shown us is that we have not been successful in clearly associating those capital requirements with the risks undertaken by institutions. Therefore, we need to pay far more attention and try to identify how can we really establish that connection between capital requirements and risk-taking. I have found really interesting ideas with the concepts of contingent capital or even counter-cyclical provisioning, and I think that is getting us closer to a system that can really provide us a much better incentive set for banks to follow. This concept of banks having skin in the game is very important, and to really materialize in appropriate regulations is of the essence. An additional point is that probably in this crisis let us know that regulators and authorities in general were too slow to react. We need much better early warning systems. We need to identify on a more opportune time when there really are deep problems brewing. Therefore, we need to know why this wasn't possible. Probably the fact that we don't have homogeneous accounting principles, that we don't have enough transparency in balance sheets, that we have probably too complex structures to broadly spread subsidiaries and vehicles are what has been, in a way, blurring our view and preventing for us to act on a more opportune time. Therefore, I would really insist in how we move forward that we need to be able to apply these early warning systems and be able to basically order the behavior of institutions on a timely basis. Now, if all this fails, of course, we know that we need to enter into resolution mode. And here, basically, the key issue is how losses are going to be shared among the different stakeholders. And of course, given the political dimension and even the fairness issues, we should try to avoid as much as possible for the taxpayer to carry the burden of a bank failure. Needless to say, I think my own personal view is shareholders should carry the cost and capital should be wiped out. And I have been surprised that oftentimes in this crisis, this didn't happen. The real issue is how do you go beyond that? How do you go beyond capital? Who will share those costs? And there is where things get really difficult. But I think that we really need to think further and be able to identify different ways to draw the line in such a way that we can still apply a resolution strategy without really enhancing or basically augmenting a systemic issue. I fully agree with Stan that the issue are, in terms of large institutions, are too large to them to enter into resolution. But I think that if we sort of follow an order, a specified order at least, we can move as much as possible closer to the optimal. And my last comment would be that I agree fully with Minister Gordhan. The fact that some of these ideas that have to do with limiting the size or penalizing or discriminating against large institutions can affect the costs and efficiency of financial intermediation in developing countries, like not only South Africa, but also Mexico, where things have been done appropriately. We haven't had a crisis, but these discrimination aspects certainly would imply higher costs in countries like Mexico, given the very high participation of large financial institutions. The bottom line there would be countries who have opened up their financial system, have received foreign investment, now would be penalized, by receiving them. So I think that that's an issue that needs to be taken into account in these discussions.
Thank you, Agustin. Davide, Serra has been very patient. Please.
The first point I'd like to make is 70% of all financial institution liabilities and equity, it's financed by each of yours pension and money kept at any bank. So financial is not a problem of banks, it's a problem of anyone living which has any savings. I'd like to start with three numbers. 9.4%. This is the average capital ratio of the 5 largest banks that have failed. So there is one point. Regulators were obsessively focused on the first line of defense, which was the amount of capital, and that has totally failed. Banks never fail for capital, they fail for liquidity. The difference is capital, it's like the fat we have in our body, while liquidity is the oxygen. If you don't breathe, in a minute, you're dead, while you can afford to be on a diet for 2-3 years. Second point, the second number I'd like to mention, 2,800 people. This is the number of people that the FSA employs. On their website, the FSA says that with 2,800 people and $500 million budget, they are regulating 30,000 firms, equivalent to 1 million employees. So it's basically having one regulator for 300 person, which are much better paid. In my view, it's like trying to regulate a Ferrari with a skateboard. There's just not a fair level of battle between the two. The third point is 0.5%. This is how much, it's the return on assets, so basically how much an average financial institution has been earning of the G20 for the last 20 years. This compares to 4% of any other industrial. So I think as a system, we need to think, the more capital, the more liquidity, the more punitive we will be on these firms, the more the cost to the real economy will increase. We have 4 simple suggestions and recommendations, hence, to be pragmatic, as we represent private capital, which at the end of the day, it's your pension, which is shareholder of this institution. The first, liquidity. So regulators have got wrong one point. Focus on liquidity. Because if you get liquidity right, then you have the time to react. You can put someone on a diet and get the guy to survive. But if a guy choke, you have no time. Secondly, balance greed and fear. If central banks and regulators were so smart to perform themselves the activity of monetary lending, we wouldn't need banks. The reality, this doesn't work. So we need private institutions to allocate capital in a private matter. As a result, there is a tension between greed and fear. We totally endorse the G20 view of a self-regulation between shareholder, regulator, and management to bring compensation down within the financial industry. We think it's fair, and most importantly, we think will create and will attract people which will not try to run banks like if they were on a Formula One Grand Prix. The third point, it's accountability. We as shareholders pay the price of failure. If something goes wrong and you're invested, you lose your money. And the fiduciary trust for us is to protect the money we have been given that will serve to pay pension liability in the coming years to come. Now, what is very important is that we require board members and regulators to have the same skin in the game. Not a single board member of any failed institution has paid back any of the entitlements that he has received, which we think it's a scandal. And secondly, we do believe that regulators need to have skin in the game. If there is failure, we want to see change in regulators. We welcome, for example, the change of leadership at the FSA. Fourth point, disclosure. As this company are private, shareholders have the first responsibility. I don't believe the regulators are there and will be able to regulate because of the inappropriate amount of people which are regulating and analyzing. But shareholders have the right and have the, in my view, moral responsibility for regulating. We can only regulate and take decision and vote in AGM if we have a disclosure. And here I think it's very important that disclosure has to be increased so that it's not just the regulator which are looking at what this company are doing, but every shareholder and every stakeholder that has something at stake can at the same time use their brain. In my view, this is the most economic sensitive decision so that everybody will regulate because all our money is at stake.
Thank you, Davide. You probably should have said, given our corporate sponsors, an Audi versus a skateboard, but we get the point. I think there's a good deal of consensus on the panel about what needs to be done. What I don't see yet is here yet is a clear sense of whether we are making progress at an adequate pace. Let me ask some of the panelists about their specific comments. For example, Stan, you made the point that in dealing with the largest institutions, we economists have a preference for using price incentives rather than prohibitions, putting heavier capital and liquidity requirements on bigger institutions if they pose more of a risk to the system. But I thought that the movement toward caps on absolute size reflected a belief in many circles that those kind of requirements can be evaded. They were arbitraged around in the past, and they may be again in the future.
excuse me, if those requirements can be arbitraged around, then there's not a lot of point in having capital requirements. So I think that, yes, you can get around them at the edges, but I don't think that you can evade them entirely. And part of what was going on with capital until recently was that second-tier capital was becoming more and more innovative, shall we say, and less real. And I think that particular lacuna is going to be closed down. On this same topic, if I may, Agustin's point about the developing countries paying the price for large banks being taxed, having higher capital requirements, they might also want to sell them if they're paying, if it costs them more in terms of capital. So you might get smaller banks that way and more local control through that mechanism. So I'm not sure you'd end up paying that particular price. Mr. Chairman, can I ask when we'll be able to introduce other issues that we think
You can introduce, all of you can introduce other issues starting now, absolutely.
Well, let me steal one more moment. The one issue that wasn't discussed was the structure of the supervisory system. And it's clear that in the United States case that some of the problems originated in areas where there was no supervision at all of mortgage granting institutions. And in terms of whether we're making progress or not, whether the structure of supervisory systems, particularly in the United States, is being improved and modernized, it seems to me that in the United States case, more rapid progress would be desirable to close all the gaps that exist in the current system and to take away the competition between regulators that the bankers continue to claim is healthy, i.e. it's healthy for them to find the regulator who's least firm, which is not something that is immediately obvious.
I would ask Jean-Claude along similar lines. Europe has multiple regulators. It has a college to try to bring them together. Can we be confident that we will get the regulatory cooperation and information sharing that we need?
Well, first of all, I would stress again that what we need is a global set of regulations which should be coherent, which should be consistent. And to the extent that now what is pertinent is the global financial system. If we do not have a global set of coordinated rules and regulation, it's a recipe for catastrophe. And we would be back to this regulatory arbitrage that my neighbor was mentioning. The case of Europe is, of course, a particular one because we have a single market, we have a European Union, and national supervision. But precisely, a large set of reform is underway in Europe, which would permit to have a much better coordination and cooperation between supervisors, micro-supervisors, than existed before. And in that sense, it's really the first lesson, if I may, that is drawn from the crisis on an institutional basis. And we have also the idea, and it is to me a very, very important concept, of engaging in macro supervision. And we have the setup of the European Systemic Risk Board, which is in the process of being decided. It's been already processed by the Council in Europe, and it is now before the Parliament. And this opens up the question, like Stan, I would like to float this concept of macro supervision, of systemic risk. What we had discussed already is part of the systemic risk. And the lesson that we can draw from the crisis is that with the best individual regulation, with the best implementation by each supervisor of the control they have to exert on firms and of soundness of the behavior of firms, in any case, there are systemic issues that are absolutely dominating, and we have to care permanently that we are not constructing a house of cards, This is very stimulating intellectually, if I may. To the professor, I would say academically, it's one of the most fascinating issues which we have all to engage on. And in terms, of course, of action, we will have to see exactly how we can be sure that we are minimizing the systemic risk in the system, because again, we cannot afford twice to have the kind of crisis we had to cope with. It would not be accepted, in my opinion, neither by the emerging world nor by our own democracies. So it's impossible to imagine. But again, a lot of unknown remain in the picture, including the very nature of some of the systemic risks.
Thank you. Both Pravin and Agustin emphasized the need for, I think you put it as differentiation, that the circumstances of emerging markets are different. But I didn't hear from either of you what specifically needs to be done, should be done differently from the point of view of reforming global financial regulation. How do you see it different from exactly from an emerging market perspective?
Let me firstly say that I agree with Jean-Claude that we are looking at this matter systemically, that if we do not find a systemic framework which will deal with the so-called hidden and non-hidden parts of the system, we won't be solving the problem for more than 6 months. And by the way, already we have difficulties with the carry trade, with potential asset bubbles, a potential new retreat home as capital flows out, impact on exchange rates, particularly in developing countries, which will also have their own serious impact as well. An example, I suppose, and I see several South African bankers here in the audience, so when the time comes, hopefully they'll speak for themselves as well, that when we set capital or liquidity ratios, take into account the particular circumstances and put in place perhaps other mechanisms that will ensure that untoward activity doesn't take place. So I think we will agree that we need to look at this systemically. We need to agree that within that system, there are the very big institutions and there are the not so big institutions. And within that overall framework, we need to find that differentiation.
Augustine?
I didn't necessarily mean that we need a different set of framework per se. I mean, I fully agree with Jean-Claude that we need a global framework in terms of regulation and supervision, and that we need to adhere to international cooperation. My basic point was more about the large firms and the differentiated treatment, no? And I think that if you have local subsidiaries that are well capitalized, they are standalone institutions, they have simple structures, and I think that if that type of conditions are observed, I don't see why the local subsidiaries need to be penalized. And also, I don't think that that's enough. I mean, it's a much simpler way to proceed if this type of exceptions are accepted than to force fire sales of institutions, no, as Stan is implying, no? I would say that even for countries like Mexico, that at different periods of time we have had banking crisis, I think it adds value also to the fact that large financial institutions can sort of share risks on a more broader base. And I think that that is adequate for more stability in financial systems in emerging markets, no? Therefore, it's a matter of balance rather than thinking of a complete different set of rules, and also of being mindful of unintended consequences of some ideas that might make a lot of sense on an isolated basis, but once you broaden them up, you have to see what the end results in other margins could be.
Thank you. Both Mr. Thiam and Mr. Serra, coming from the private sector, reminded us that no institution should be too big to fail, and that every boat needs to float on its own bottom. We need a resolution regime, and one that can actually be utilized in order for that admirable sentiment actually to be implemented. Is the way to go here something like prepackaged bankruptcy? Will that work? Can we do this at the national level, or do we need a global resolution regime sitting in the private sector? How do we go about making it clear that when a big financial firm is in deep trouble, it can be resolved?
I'll just say, first point, I think the idea that the FSA has raised on contingent capital, it's a good idea. In any other corporate, the day the equity is worthless, the debt gets transformed into equity. And I think as a result, we should have a clear view how the capital structure from senior secured becomes unsecured, from how unsecured becomes equity. In this way, everybody takes a bit of an haircut, but at the same time, the financial stability holds. One of the key problems in the current framework regulator has been that the insurance company have been the largest buyer of Tier 1 and Tier 2, which they were buying simply on the basis that was debt. The day become equity, had the risk, as we heard, of bankruptcy, of basically sending bankrupt many banks and lots of pension systems. So contingent capital and a clear way how whoever is financing a financial institution is taking a bit more risk. Secondly, though, which I think is even more important, is we want a total change on the way the people are regulating. I'll give you an example. In the US, 6 regulators, a disaster. In the UK, they had 3. The country which had 1, doesn't matter who, end up regulating better the system. Secondly, I don't believe, and we are practitioners, if you want to run, let's assume you are in Formula 1. You have a fast car, you want the best driver. You want Schumacher. So we would like to have the best CEOs of financial institutions that have emerged out of this crisis every 5 years to take responsibility of the financial regulation and be appointed close to the central bank, whether it's the ECB, whether it's the Fed, so that monetary policy has on the right-hand side the best private sector regulator that is the guy that has been running and had skin in the game. In this way, we will have price stability, which I think, for example, the ECB has beautifully pursued, and at the same time, the best regulator because he's been playing the game himself, so he knows how to bypass the rule. But to do this, we need to make sure that these people are properly incentivized, properly remunerated, no scapegoat, because if you want to get the best Schumacher from the field to come back and regulate, you can't afford to give him a public servant salary. Otherwise, it won't work. The cost is so limited to the old pension system to the world that I think we should try to get the best guy to be the referee. Why? Here, it doesn't matter who win or lose. If anyone lose, we're all in the same game. Hence, I'd rather have the Platini of the world as a referee.
Thank you, Mr. Thiam.
If I can just build on what Davide has just said, for me, one of the key issues goes back to one of his comments around disclosure. Talking about banks and insurance companies, I think one reason why insurance companies did better actually in this cycle is back in 2002-03. We went through an absolutely terrible time as insurance companies where many of us came very close to bankruptcy. I'm sure those who know London will remember that Standard Life had to sell 7.5 billion of equity, on the FSA's request suddenly because we used customarily to invest shareholder funds in equity. And I think what we've learned since then is really the importance of economic capital and the importance of running the companies, whatever the accounting says, on a risk-based basis. And that was really absolutely central in reforming the way insurance companies are managed and in allowing us to go through this cycle in a better way. I think without sounding or wanting to lecture banks in any way, but I think one thing they've learned through this cycle is that paper profits are not cash. You can really have very high paper profits if you pay cash bonuses based on accounting, notions. You're going short cash, and that's always a very dangerous position to be in. So I think we've learned our lessons there, and I think the need to align the accounting and the economic reality is vital. One way or another, we need to get ourselves in that position across the financial services, because I'm never happy to, there's no schadenfreude in me, I'm never happy to see banks in trouble. So at the end of the day, we're all on the same boat. People who think that, okay, we're going to get the regulated sector in good shape, all we're going to do is chase a lot of bad behaviors in the unregulated sector. Whether they're guaranteed or not, when they go bankrupt, it becomes systemic. So I think in thinking about all this, we really need to try to bring everybody together and align everybody and go back as much as possible to a risk-based capital regime.
Thank you. We have about 10 plus minutes for questions from the audience. So I would encourage questions to specific speakers rather than statements. I'd encourage you to identify yourselves, and I would encourage you to wave your hand quite visibly because the lights are shining in my eyes and it's hard to see. I see a hand over here.
Yes, I'm Jeremy Warner from the Daily Telegraph in London. We're seeing growing political and populist. This is a question for Jean-Claude. We're seeing growing political and populist frustration with the slowness and the complexity of the international reform agenda. So you're beginning to see countries imposing their own solutions, notably Britain and particularly the United States. How dangerous is this fragmented approach to reform, and what can the international effort do to get back on the front foot?
Well, I insisted very much, I stressed very much the necessity to have a correct functioning of what we have all decided in the time of the crisis. I think there was a consensus which is absolutely remarkable to consider that we had to change dramatically global governance and to enlarge global governance to the emerging world in order to be sure that there would be an ownership of the reform that are necessary. So I agree with you, it is extremely important that we could process all ideas, and Stan said, I think he was right to say that it's not abnormal that we have ideas that are born here and there. The UK, Germany, France, the US have launched ideas. What is extremely important is that they are looked after seriously, of course, within the framework which has been agreed upon by all G20 countries, and including my neighbor minister, and including Agustin when he was minister. Now he's governor of central bank, and we are working together. It's extremely important. We won't solve our problem if we don't remain united. We have an immense chance in this very, very demanding and difficult episode that we are experiencing. We had a consensus to say it cannot continue. We have to change the governance of the system. We agree that market economies are the best way to produce wealth, but we also agree that the market economy global system must be much more solid, much more resilient. So that's the way I would comment on your question.
I saw a hand right there.
Okay. I'm Hu Shuli from China. I'd like to know the views of all the central bankers and financial minister about your opinion on the exit issue. I mean the exit of stimulative policy. When and how? Thank you.
So I don't know who wants to take that. I can give you my views of.
He should confess to you that he's writing some book, so let's give him half a minute to confess about this issue.
I think that fairly was a question for the panel in this room late this morning, where there was, I think, a consensus about proceeding cautiously when heading toward the exit. And since I have the microphone, I would like to add my voice to those who would subscribe to that view. There was a hand here.
Sorry. I'm Shamit Banerjee, Booz & Company. Question for Stan Fischer and Monsieur Trichet. I'm just curious in sort of the mental model of thinking about the new world of regulation, whether you're thinking about things more in the context of moral hazard or problems of information, which would drive you towards a world that looks much more about mechanism design, compensation, risk-based capital, and so forth. Or is there a sort of concern that this is really about bubbles and something much less well understood, in which case, presumably, that drives one more towards despair?
I think it was directed to Jean-Claude. Have a few words, and Stan wants in on this one as well.
Yeah, and I would also be very happy that we would all respond, because we are all on board. No, if I understand well the question, I would say that we are looking at everything. What we have to be as reasonably sure of is that we have a system which, again, is much more resilient. And so we are concentrating very much on banks. They are not only the banks. You have also pension and insurance company, as Mr. Thiam is stressing. We have also the markets themselves. I mentioned myself the infrastructure of the market. It's very, very multidimensional what we have to do. We have the non-banks that were not regulated before, and we have to take care of that. We have the rating agencies. We have the accounting rules, which have been mentioned. I mean, it's really the full body of the system that we are X-raying, and we are trying to see where and when we have phenomenon of procyclicality. In a market economy, it is absolutely normal that you have fluctuations. If you had no fluctuations, you wouldn't be in market economies, and it would be a recipe for the total catastrophe of Soviet Union type. But it is very clumsy by our own making to augment the amplitude of those fluctuations, and it is what we call procyclicality. So we have identified a lot of areas, including in our rules and regulation, including in the prudentials, that we are procyclical. And again, we have to combat that. And we have also, of course, to be sure that there is no black hole in the system, and that, as I said, we are taking care of a phenomenon as complex as herd behavior, contagion, systemic channel of transmission that proved to be very catastrophic. But I would say we have no dogma ex ante. We are looking at everything. And I would say under the two dimensions that you have mentioned, we are working as actively as possible.
Stan?
You mentioned, at least I wrote down at least three things you mentioned: moral hazard, information, and bubbles, and they're all being thought about in designing the system. I think in bubbles, in trying to control bubbles, the macro-prudential emphasis that is now taking place is essentially concerned with that, could be described as being concerned with that issue. So is the counter-cyclical capital requirements proposal. On moral hazard, that's obviously the whole too big to fail, too big to resolve, too interconnected to fail. All those discussions are moral hazard discussions. And then on the information, I would like to make a point which is related to what Mr. Serra said about 2,800 supervisors for 1 million people. I think this debate has gone a bit too far in the direction of trying to put responsibility on supervisors and boards of directors. The people who have the main knowledge, the most information, are the managers. And as you move up from the managers to the board of directors, there's a loss of information. Sometimes it may be intentional. And as you move from the boards of directors to the regulators, you lose information. And it's very difficult to regulate a system well if it's not well managed. I think somehow the management issues the management avoiding risk-taking is related to the whole discussion of compensation practices, which is not merely about not irritating the public, but also about encouraging the banks to control their risks better. So I think the information issue is absolutely central to the question of whether you can supervise and who should supervise and how. So all these aspects, as Jean-Claude said, have to be taken into account.
Thank you. The gentleman with the microphone.
I'm David Tuckett. I'm a professor of psychoanalysis at UCL in London. I wondered whether you would be able to think about, isn't there a deeper problem to those that you've been discussing that are related to it, which is that we've allowed financial markets over the last 30 years to become far too exciting and, in effect, to be run as a casino, indeed, as Keynes commented in 1936, and that, as Mr. Serra said, it's okay to have a few people speculating, but for the whole market to be based on principles of risk-taking of that kind is very problematic. And isn't it our problem, all of our problem, as you point out, it's our pensions?
I guess I would look down toward that end of the DS.
I think the 2 points. First, let's not forget that all the crises have started from lending on mortgages. Mortgages are people, people vote. For the last 8 years, every G8 government was very happy to get tax receipts from a booming houses prices. And whoever was taking a mortgage was very happy to pay very little and have mortgages up to 100% without loan to value. Secondly, as a bank, you're financing the real economy. What does it mean? You're financing project, you're financing company, you're financing individual, you're giving credit. That's a big risk. The reason why banks have failed is because they've been giving money away for 20 years in mortgages, 7 years, LBO. So money, for 7 or 20 years, everything had to be as you expected. And hence, I think today the debate, the buying or selling shares, i.e. equity, the most liquid instruments, even at the point of the highest crisis, is how the crisis has emerged, is intellectually dishonest, factually wrong, and is just an scapegoat for avoiding the responsibility that we all share. Hence, my view is separation. It's important to retain brain in this institution to take risk. Risk is forecasting the future. The future, by definition, cannot be forecasted, which is why I would love to have less regulator and less rules. Try to read the Basel Committee. I have a very good degree studying in France, in Bocconi, tried to study. I've been analyzing financials for 15 years. I have a hard time understanding it. And I'd love to have less people, brighter, more simple, better paid as regulators. Why? To forecast the future, you need brighter people and less model. Numbers don't drive the world. Rules don't drive. Human beings do. So less regulators, better paid, smarter. And maybe let's have a vote as an industry. Who do we want as regulators? I'll know who I want to vote in, the job. Let's see if we all have a view.
Pravin, your word is going to be last, aside from mine.
I actually want to agree with the questioner that perhaps financial markets have become too exciting. And if I use Mr. Serra's analogy with Schumacher, Ferrari implied, and the F1, that's clearly the case. And one has to ask if money is to be made from the real economy, and if that real economy, because of the connection to the financial system, is actually damaged in the way it is, aren't we actually encouraging the financial markets to a level of creativity which almost amounts to a system on steroids over a decade or more? And uncontrolled steroids, there's no drug tests involved here, until there's a crisis and a bust actually takes place. So I would actually agree that the paradigm has to be revisited. And we need more conversations about that and a recognition that we're moving into a different era.
All right, Tidjane, very, very quickly, please.
Very briefly, I'm just concerned when we argue about innovation. I think that there is a risk-return efficient frontier, you need high risk, high return activities that are good for the economy. The problems are what Stan Fischer said of the boards not understanding those underlying risks or regulators not understanding them and not being able to contain them or manage them. But I really think that the answer is not to cap the absolute level of risk and say one shall not go beyond that, because that will be damaging for the economy in the long term.
And we have similarly reached our frontier. I think I have heard consensus on the importance of consistency and predictability, on the need for global treatment, that both capital and liquidity matter, that countercyclicality is desirable, that information is important, but I haven't heard consensus on whether we need a more complex or a simpler regulatory framework. And I think the big unknown is that resolution regime for large institutions, so we have more to talk about. Thank you.